There he is.
Okay, looks like we're back. Sorry about that. I lost you guys and I couldn't get you back, so I finally just went and rebooted my modem, and hopefully that's going to be good now for the rest of the night. But it's the second time today I've done that. Yeah, I don't know. My apologies. But anyhow, well, let me share the screen here. So there we go. And so it's our last night together. Anyhow, hopefully you guys will feel like you got a lot out of this course. One of the things I thought about on my 12-hour drive back from the Black Hills in South Dakota was I may write a book that I'll use for this course in the future. I may do that. Yeah. And if nothing else, I don't know if it'll sell, but I'll at least make students buy it for this class. Yeah, I think I could write a good book for this. Anyhow, so what are we going to do tonight? Well, we were going to, I have several things like downloaded plus some, I know we have the valuation stuff to cover. Let's see. So I think if I look here on the review for the final, isn't that kind of where we left off, was doing discounted cash flows using free cash flows to equity, right? And then I think I did just a real quick run through of the handout on discounted cash flows, and then showed you that the worksheet and the solutions to the worksheet. I also told you for the test, I'm only going to hold you responsible for using free cash flows to equity. You will not have to use free cash flows to the firm in doing your DCF valuation. And then we got a few loose ends to tie up, and we're pretty much done after that. Hey, you guys want to tell me, what did we plan for the test as far as that goes? What did I tell you that we would do the test? Was it Friday and Saturday? Was that right? Okay, that's what I was thinking, which is what we did on test one, right? Friday and Saturday. So again, I'll do the same thing again. I'll open it up like 8 o'clock Friday morning and close it up midnight or 11:59 p.m. Saturday night. And again, you'll have I think I'll make it all multiple choice again. And give you the 3-hour time limit like I did last time. Any questions on that? How about two, before we get started, questions about your project, your paper? Any questions on that?
I have a quick question.
Yeah, go ahead, Rachel.
So, as I was writing, I was looking through the syllabus, and it had all of this information that it wants in the header of the paper. Can you maybe show me what that looks like? Because it seems like a lot of information to put in a header.
Yeah, actually, if you go to CFA Institute, so let me do that. And it's not .com, it's cfainstitute.org. Well, let me do that on here now, and let's go ahead, move over to here. Okay, so I'm going to go cfainstitute.org. I know a couple of people. I know James has already looked at this because he said, was there a specific template to follow? And oh, wow, I have my news on mute in the background. Mary Kay Letourneau, remember the teacher that I guess she died? Huh? Passed away. The teacher that had an affair with her 6th grade student, and then when she went to prison. Then when he grew up, they got married and had kids. Remember that? Anyhow, yeah, she just died, I guess. That just kind of caught me off guard. I thought I just saw it on. Okay. So this is the CFA Institute website. And then, okay, log in. I don't think you need to log in though. I think you can go to, let's see, nothing else. Right? Yeah, cfainstitute.org. Member benefits, events, ethics and standards. Where is it? Huh. This isn't normally what comes up in the past when I have gone on here. So what the hell's going on? I don't know. Here, let me maybe do this. No, that doesn't seem like. Okay, there should be somewhere on here where you can see past CFA Institute. Oh, they called it the Investment Research Challenge. And oh, here it is, Research Challenge. Okay. And you can go to like past champions. By the way, I don't expect, when you look at the stuff that past champions have done, don't feel like, oh my God, I got to do this much. But just, I think they're probably going to, I know they have some stuff on, okay, read the team's written report. So, okay. Now this is from the University of Sydney, and well, they didn't actually put everything on the cover page like I would have expected, did they? There's the executive summary and business description, blah, blah, blah. Anyhow, I don't expect yours to. You can see they put a lot of time into this and a lot of effort. That's not a, but they didn't follow the rules on the cover page, did they? I don't think it was supposed to look like this, because what weren't you supposed to have the name of the company, its ticker symbol? They do have that. Well, I guess they do have the exchange. Okay, they do have all the information right here that was asked for on the cover page in terms of, yes, they have the name of the company they're covering. They do have the ticker symbol. They do have the exchange that it trades on and its industry. So, and their final recommendation, which was a sell recommendation. So again, I don't expect yours to be anywhere near as comprehensive as what, this is the team that won for the entire world, right? So obviously it's pretty intense. But yeah, I think you should be able to, if I go back here and go back to the syllabus, and look at everything that goes on there. I think you can get it all on there, Helen. Let's see here. Okay, so on the first page, company name, the exchange, ticker symbol, sector, industry, the recommendation, current price, target price. Yeah, that's all. And they fit all that into that little tiny header on that first page where they had their executive summary, which the rest of this is just kind of in terms of following the rules of it. But yeah, so you start with the business description. But yeah, so you can get all that on there fairly easily. All right. Other questions about or Rachel, was it you that asked that? Yeah, I'm sorry. I think I attributed it to Helen, but it was you, Rachel. Okay. So yeah, Rachel. But any other questions about the assignment itself before we get going on material.
So just looking at that, sorry, Rob, it's Sarah. So it
Yep,
doesn't,
I could tell that time.
sorry.
Actually, I knew it was Rachel before too, and for some reason, I don't know why I said Helen. Yeah.
So looking at their paper, they don't have like the target price in the header. If we did something similar to what they have, would that be sufficient, or
They didn't
you
even.
actually?
Yeah, that would be fine. I'm not going to dock points because you missed one item in the cover page, unless like the item is you didn't tell me the name of the company or something like that. But yeah. So don't worry too much about that. I mean, try to follow that for me. They really did not have it, so I got to look now.
It's on the page, but it's not in the header.
Oh, it is on the page, but just not in the header. Let's see.
Yeah, on the left-hand side.
Oh, yeah. So, yeah, I guess, yeah, they didn't put it in here. Yeah, I'm not going to get real picky about anything like that. I'm looking more at substance. I do want you to have a target price. I want you to tell me what you think it's worth. Certainly I want you to do a discounted cash flow analysis for that. I would also like to see maybe another valuation metric too, where say, well, I think an appropriate price to forward earnings multiple or appropriate enterprise value to EBITDA or something like that, based on that, here's what we would get as a value and so forth. So maybe use at least one other measure besides discounted cash flow. Obviously, the valuation piece is always the hardest because it relies on assumptions. So, if we go straight to, there's a description, let's go right to the investment summary. And financial analysis, didn't get there yet. Here's their valuation section. So that tends to be the part that I would say sometimes, if I had to pick one part of the paper that seems to be a nemesis for some students, it's the valuation section. And typically, it's not necessarily that students have made mistakes, although sometimes there are mistakes in the valuation section. But more than that, what typically it is they don't tell me any of the assumptions they were using or where they got those assumptions. They'll just say, well, the growth rate is X, and we decided the cost of equity is Y, and so forth. But they just don't give me any reason to or logic behind where they got those numbers. Again, sometimes some of it is being, well, this number just seems appropriate, based on this, and this. But give me something to explain where these assumptions came from, so I don't have to assume they just got plucked out of the air. So that would be where maybe just looking over their valuation section here. They did a dividend discount model. You could do that if you wanted to. They did a residual income model. You can do it if you want. Relative valuation, price to book value, and okay, and then they talked about the valuation risk. And okay, did they not do a discounted cash flow analysis? They had to have. They couldn't have won this without that. I wouldn't have thought. Valuation, price to book value. Well, you know what? Yeah, they do have price to book value. They also have a PE. And maybe because it was a bank, this price to book value versus return on equity, global banks regression might have been good enough. And then on the dividend discount model, the dividend discount model basically is a discount cash flow model, but it's based on dividends rather than free cash flows for the whole firm. Well, the thing about banks is cash flows for banks are usually negative, right? Because they're loaning money out, and they're putting money out today in exchange for taking money in the future at some particular rate of interest. So a lot of times they don't even have positive cash flows. They did use cash earnings on the residual income model. So this one may not be, did I tell you guys before, banks are probably not the best ones to use, but that is what this group used. I'll bet though we can find, let me do this. Right down. How did I get here? Let me just go back. And what was the other one? Seton Hall were the America's regional final champions, representing a CFA Society of New York. So let's see if we've got one for them. That was, there's one for the Philippines. Here's regional final champions. Yeah, I do. Here's one for the Americas. Well, that was Central America. I mean, not that there's, and this was a different year, but anyhow, there's several of these you can look at, to see like, that's the University of Sydney for 2020. 2019, it was Philippines. 2018, it was Switzerland. Let's just take a look at one other valuation section where they're likely to have used. Business description. And again, make sure you follow the outline that I put there. Financial. Here's the valuation. Okay. So they were doing they use free cash flows for the firm and a weighted average cost of capital calculation that you can see there. So they come up with a compound annual growth rate of 8.2% for semiconductors, 83% or 33% adjusted EBITDA margin achievable in a 5-year time frame. Now, that was probably based on guidance company. From the EBITDA to the free cash flow estimates, and they talked about their capital expenditures, et cetera. And then the risk-adjusted discount rate, how they got, the rate of return. So maybe instead of using that one from Sydney, it might be better to use one of the ones from past years. And again, I'm not expecting anybody to do as much work as these teams put in, because that's those teams, some of them put in hundreds of hours on this, and I know you guys actually have a life too, so I don't expect you guys to be quite that much. Okay. So I'll move us up here, and then I change this. There we go. There. Why is it doing this now? Now I got a horizontal instead of Here, yeah, I'll just do that. Okay, well, no, I want to see everybody though as I talk. So any other questions on the report? And when did I say it was due again? Did I say Tuesday or Monday? Remember?
Said Sunday, but I'll take Tuesday.
I think I might have to have your grades in on.
Rob,
Either
Rob,
Tuesday.
Tuesday,
Hang on just a second,
Tuesdays.
Hang on,
Rob,
Jean-Pierre, wait.
Yeah.
Wait.
Rob, I think.
Wait. Okay. I think I have to have grades turned in Tuesday. It's either Tuesday or Wednesday on grades. So yeah, Sunday night would be good. You know, Monday by noon, I can give you that. All right, there, you got it. In fact, I'm going to write it down so I don't forget. Monday by noon.
But Rob, I thought like last time you said Wednesday.
No, I don't think so.
I think so.
Simon, that's what you thought I said?
The,
Yeah, no, I think I said grades were due Tuesday or Wednesday, so I have to have the.
oh, okay. All right,
Yeah.
maybe that's what.
So let me just write down Monday by noon for securities analysis. Written research report, whatever you want to call it. Okay, so Monday at noon, it is. That's the deadline. Okay. Any other questions?
Yeah, Rob.
Yes.
On the report, yes, I could see different valuation based on the book, the book value, and valuation that is different, and valuation based on the dividend, the dividend discount model, valuation based on the cash flow model. So my question is, for our project, do we have to do like two or three different valuation, or just
I would prefer,
only one?
you do a discounted cash flow analysis using free cash flows to equity.
Yeah.
And I would prefer you do at least one other valuation method. Yeah.
Okay, it's like
Price to earnings, or whichever other one you want to do. Enterprise value to EBITDA, price to earnings multiple, price to free cash flow, whatever other one, price to book value. Just one other metric.
Okay.
Besides just using the free cash flow to equity, discounted cash flow.
Yeah. Okay. So that's okay. One for the valuation. So what about the risk for said the investment risk?
Yeah. So did we get into did we go over the risk factors yet?
Yeah.
We did.
No.
Like I thought we kind of did. Talked about size of the company, complexity, things like that. No. Okay. Well, let me go back to our review sheet here, guys. So give me a second. All right. So anyhow, by the way, this is all on the research challenge, and you go to cfainstitute.org if you want to see what, get an idea of the types of things that world champion students did. And again, I'm not expecting that much. I do expect you guys to do a good job, but I'm not expecting you to do what these world champion teams did for theirs. Okay, so I'll close that site down.
Also, Rob, I have another. Yeah, we are facing, like, for the graduate segment, we are facing or choosing the second company. So why? Because most of the company that we identify, those companies are both on Morningstar. So it's quite difficult for us to identify a company that is not on Morningstar. So
well, all companies are on Morningstar, but Morningstar only has an analysis on about 1,500 of those companies. So remember, and remember, if you're doing two companies, I said one of them could be covered by a Morningstar analyst.
Okay, so what about the second one?
No, one has to not be covered by an analyst.
Yes, that's why. So it's difficult to find a company not covered by Morningstar. So we find a company, but is a private company. So the only information that we have is the information on the SecGov, like the 10K and So,
right. Yeah. You can also go to the company website and look at guidance that the company has put out. You can also go to the finance page of Yahoo, finance.yahoo.com, and you can find all kinds of information there, including analyst projections for earnings for the next couple years, plus the growth rate in earnings per share over the next 5 years. And yeah, we have kind of looked at a lot of that. Jean-Pierre. By the way, you had mentioned risk. Yeah, so we did talk about factors affecting risk. What we did not talk about as far as discounted cash flow analysis using free cash flows to equity is the cost of equity yet, but that's what we're going to get into tonight because the risk is going to affect, your cost of equity. But yeah, remember we did some screens, didn't I? I'm positive. I know I did that last time, where we did a screen on Morningstar for companies not covered by Morningstar, and it came up with like, I don't know, 14,000 or something like that. And then we threw in some other parameters to kind of narrow it down. So it is fairly easy to find companies that are not covered by a Morningstar analyst. It'll still be on Morningstar, but it just won't be covered by an analyst. Does that make sense, Jean-Pierre?
Okay. Yes.
Okay. Let me get your picture back in here. Okay, so that makes sense then. All right. So yeah, you can run a screen. Do you remember when we did that last week? If not, maybe go back to the recording, which is if you go to the link for the recorded meeting from last week, it's on YouTube. Go to that, and if you go back through that meeting, we did talk about running screens for companies on Morningstar. And I can't remember if it was last week or another time, but we have looked at the finance.yahoo.com page before. And I thought we did that last week as well. Wasn't that last week? Because we were looking at PEs and enterprise value to EBITDA. And then we also looked at analyst growth rates. So again, I would say on all of that stuff, Jean-Pierre, if you review the recording from last week, and obviously parts that are things that you're already familiar with or know well, skip that, but go to the, find the things, just check every, few minutes along to see, okay, is he explaining something that I might have a question on? Okay? Yeah, because I think we did cover that.
Yeah. Thank you.
Yes. Any other questions?
Rob?
Yeah, who's saying that?
Show.
Oh, hey, Show. Yeah.
Hey, where do you find the debt ratings for a company?
Debt ratings? Oh, good question. Okay. And I don't know if I showed you that. I don't think I did. Don't think I did. So let me do that. Okay. If you go, my favorite one to go to is finra.org. That's FINRA.org. So right here, I'll go to it. FINRA.org. FINRA stands for Financial Industry Regulatory Authority. Okay. In fact, they regulate the investments industry. So like, you know, we get reviews and have to take tests and stuff on FINRA stuff all the time as a financial advisor. Okay, I'll click on it. All right, and okay, I'm gonna move us over here. So for investors, okay, you go to this tab, for investors, and write this down. Then go to tools and calculators. Okay, so it's finra.org. Then hover over investors. Then go to tools and calculators. Click on that. Okay, and leave. Now let me move us over here. Okay. I think it's in FINRA market data. Let me just scroll down quick and make sure yeah, okay. So under FINRA market data. Okay. Then you see where it says bonds over here. Click on bonds. You know what? I should probably put a handout out there. I will do this, and Jean-Pierre, you'll appreciate this too. So I'll put a handout out there, not only for the FINRA ratings. Let me first make a note, and I'm going to do it. Okay. Okay, handout. I'll put it on there for to show you how to get to finance.yahoo.com and also FINRA and also the CFA Institute. You got all of that. I'll do it if not right after class. I'm supposed to meet my wife right after class, so it might be tomorrow before I get it on there, but I will do it. Okay, so again, we went to finra.org, and then we went to investors, or for investors, I guess technically, and then it's tools and calculators, and then it's market data, and then it's bonds. Okay. So now that we're into bonds, we can go to search. So then go to search. All right. So let's say we want to look up bonds of, I always go by issuer name. You can use the ticker symbol of the company too, but okay. So let's say we want to see bonds for Tesla. Okay, so I put in Tesla, show results. Oh, you always have to agree to their user agreement. You guys read all that, right? Okay. And we can see that, okay, all Tesla's bonds right now are rated single B minus. The ones that are rated single B minus by Standard & Poor's and CAA1 by Moody's. which if you know anything about bond ratings, and you should by the time you're in this course, we know that's junk rated, right? Because triple B minus is the lowest of the investment grade category. So anything rated below triple B minus is junk bonds. So B minus and CAA1, those are definitely junk bonds. Now, if I went in instead, let's edit the search and do a different company. We mentioned Home Depot before. I'm going to do a search again, and it's for corporate bonds. And this time, let's do Home Depot. Now, again, on the one hand, you would think Home Depot would have low ratings because their equity is negative. They're on their balance sheet, their debt exceeds their equity. But remember, we also said if you look at debt to EBITDA, their debt to EBITDA was like 2 times or less, which is actually really low because as a general rule, 4 to 5 times is when you start to get worried. Their debt to EBITDA was only 2 times. And so we see that, yeah, they're rated single A by Standard & Poor's, same rating by Moody's. Standard & Poor's would go A plus, then A minus in the A category. Moody's goes A1, A2, or A3 in the A category. So both of them are rating all of their bonds in the middle of the A category, which is very good. Okay. So those bond ratings can give you an indication of the riskiness of the company. If the bonds are risky, then you know the stock is risky, right? Because the stock is riskier than the bonds. So if the bonds are risky, the stock's really risky. And of course, Tesla, God, are they up to like, wasn't it close to $1,400 a share now
Almost
on Tesla? How much, Matt?
14 something, I think they cracked.
14 something. Yeah, incredible.
I mean,
And again,
Amazon,
everybody's like, well, how do they arrive in their, there's no logic to that valuation. There is no logic. Everybody just keeps buying it because it just keeps going up. Well, sooner or later, I got to believe it's not going to keep going. And especially, we've had some new electric vehicle companies just go public here recently, that Nikola, and there's a couple other electric vehicle companies, plus the regular car companies, GM, Ford, et cetera, they're going electric vehicles too. And on top of that, Tesla came out with very bad ratings by what is it, Consumer Reports or the whatever it is. They got like the lowest ratings on the measure of like quality and stuff, quality measures. So I just, again, I see Tesla as a cult stock. It's like Trump, okay? I compare. I'm not saying if you're voting for Trump, you belong in a cult or you're part of a Trump cult. What I am saying is the people who, no matter what he says, he can do no wrong. My uncle thinks he walks on water. Okay, well, that he's drank the Trump Kool-Aid. I think some people have drank the Elon Musk Kool-Aid, that Elon Musk can do no wrong, and so Tesla stock is just going to keep going up until it doesn't. And again, I've never shorted the stock. I've been asked by students if you're so convinced that, and in fact, our investment club owns a couple of shares because we finally decided, well, it's a speculative stock, but you know, the way it's been going, why not put a small amount of money into a couple of shares? And like we bought in around 800, 900 a share, and see what happens, you know, and as a speculation, and it's just continued, it's marked higher, and it may continue yet. I mean, there is no rhyme or reason to it. There just really isn't. But you know, I wouldn't buy it for myself personally, but I also wouldn't sell it short. And again, the reason I always cite that I wouldn't sell it short, even though I consider it overvalued, Why? Because just because people are crazy doesn't mean they can't get crazier. And that price is crazy, but it may get crazier. You know, again, I call it the Elon Musk cult effect. You know, if Trump had a public company right now that was all based on Donald Trump running the company, there would be Trump fans that wouldn't care what the price was, they'd buy anything he's selling. So anyhow, okay. Well, any other questions then? So I'll get some of this out there. I'm not going to get out there tonight, but sometime tomorrow, probably late tomorrow afternoon, because I do have my granddaughters for a couple hours tomorrow, but sometime late tomorrow afternoon, I'll get some more handouts on there to help you. Okay.
Rob?
All right, any other questions? Or are we good?
Rob?
Okay, hang on. That sounded like show. Yes.
Yeah. So in the rubrics for the paper, this is debt rating. Is that same as bond rating, or
Yeah,
it's a different thing?
that's
It's the
exactly
same
what I
thing?
meant. Yep.
Okay. And then one more quick question. So I looked up bond rating for two companies I'm working on. One has bond rating in here, but the other one doesn't. So
It either means they don't have any interest-bearing debt. Does their balance sheet show like long-term debt or short-term debt? You're
I
not
haven't
sure?
looked at it.
Yeah.
I'm not sure out of
Well,
my
put it
notes.
this way. Either they don't have any interest-bearing debt, or if they do, it may not be publicly traded. It
Okay.
might have just been privately placed with somebody.
Okay. All right. Sounds good.
Great. Okay, I can take maybe one or two more questions, then we probably better get to our material unless you guys want to be here longer than our normal 2 hours tonight. You would like that, wouldn't you guys? You're gonna miss us all. We're gonna miss each other here after tonight, aren't we? Yeah. Hey, maybe I should do what I did with the cases class and say, let's next Wednesday at 5:30. I did this with my cases class. Only a couple people showed up. I think we had two or three people show up out of class, and I showed up. But we met at Moco, at bar over between Coe and Mount Mercy. I think it's on E Avenue, just a couple blocks up from the old TikTok. It used to be called, way back in the day, it was called Mahoney's. Then it was called, after Mahoney's, it was called Dick's Bar, and anyhow, it's Moco. So I will go to, I'll do this, because I'll go even if nobody shows up. I'll go to Moco next Wednesday. I've gone into lots when I was out there, I was on my bike when I was in the Black Hills and my niece goes, well, if Craig and I go over here, will you be okay going to the bar by yourself in Deadwood? I said, hell yes. I said, I love going to bars by myself. I do it all the time. I mean, not all the time. I do it a lot. So I'll go to Moco, 5:30 next week. Oh, Show, you were there last time. Yeah, Show joined us last time. A couple other people who didn't make it were supposed to come and had things come up last minute. But anyhow, 5:30 at Moco. Hey, Jean-Pierre.
Yeah.
John? Yeah, could you mute your, here, let me put you on mute. There we go. Okay. Yeah, so next Wednesday, 5:30, Moco's. Anybody who wants to join. Okay, any last minute question then? On the, I'll take one more question on the thing. Okay, let me unmute you here, Jean-Pierre.
Rob, could you send the address of the place for next Wednesday?
Moco? Sure.
Yeah.
I mean, you could Google it, but it's MO as in the first two letters of Mount Mercy, and then CO for the first two letters of Co. That's why they named it that, because it's like between Mount Mercy and Co. So they called it Moco. And they used to have a Mount Mercy flag and a coal flag at one at each end of their bar, but I think they took those banners down. But anyhow, yeah, so it's right there past the TikTok, but I'll Google it and see if I can find the address. Well, I know I can, and I'll just Google it and send you the address. Yeah. Okay. Anything else
Thank
on
you.
the paper? Yeah, you bet. Anything else on the paper? All right. Well, then let's move into our material. So, whoops. We want to first let's review this discounted cash flow valuation of a company. And again, I'm not going to hold you responsible for this part, using free cash flows to the firm. Those of you in cases, that's what we did, and we used the weighted average cost of capital. Instead, for this class, we'll just use discounted cash flow using free cash flows to equity. It's a little bit simpler, and so it saves us a little bit of time. Okay, so number one, determine free cash flows to equity each year until a constant growth rate in free cash flows is reached. Now notice you've got a footnote there that says free cash flows to equity equals net income, and then you add back in depreciation and amortization expense because those were non-cash expenses, and then you subtract out capital expenditures because you do for plant and equipment, because you do spend cash for it, but it doesn't affect your net income. And you subtract out the change in net working capital, which usually you would expect net working capital to equal a certain percent of sales. Okay, so if sales grow, your net working capital, in other words, current assets minus current liabilities, will likely grow as well. At least accounts receivable will grow for sure if your sales grow. Inventory is likely to grow if your sales grow, but on the current liability side, accounts payable is also likely to grow if your sales grow. So again, those current assets that are directly related to sales, like accounts receivable and inventory, less accounts payable, which is the current liability directly related to sales, generally will be growing. That number would be growing over time as your sales. So that's how you're going to find those free cash flows to equity. Next, determine the terminal value of the firm once a constant growth rate in free cash flows is reached. And this is just like your dividend valuation model, where we said, if I put it down here, we said, well, the price today, and then if I put in a subscript here, P sub 0, okay, and then I take out a subscript, equals, whoops, equals, actually, let me give it a space there and put that in. Equals, well, it does it that way for some reason. And then we would have D sub 1. Oh, I don't know why that's up there. That might have been why we got that sign like that. There. Equals, no, still do it that way. Okay, anyhow, D sub 1 divided by, whoops, I don't want to use it as a subscript, divided by K sub E, cost of equity, okay, and then I get rid of the subscript, minus G, the annual growth rate in dividends. So it's exactly the same formula. Remember what this formula that you learned this one like in finance. And remember what we said that formula did? We said that discounts all future cash flows theoretically to infinity. theoretically to infinity, discounts all future cash flows back to present value today. Okay, well, this is the exact same formula. Okay, once you reach a constant rate of growth, the next, the first year that you have a constant rate of growth would be n+1, where year n is the last year of high growth. So year n+1 would be the first year of a constant growth rate. Take those free cash flows to equity instead of the dividends and divide by K sub E minus G, the required rate of return of stockholders, minus G, the growth rate in dividends. Same thing as the dividend valuation model you learned down here in financial management, way back when. Okay. Now you see that G is the terminal growth rate in free cash flows. Now, it says discount all free cash flows and the terminal value back to present value at K sub E, which is the required rate of return for common shareholders. To arrive at the common equity value, okay, then you simply divide that total equity value by the number of shares outstanding to get the intrinsic value per share. So maybe I should put a third footnote after K sub E here. And in fact, I will. I'll just go star, 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 and then down here, enter, and star, 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 and put K, and then sub E, okay, and take the subscript out, equals. Now, do you remember the capital asset pricing model? Those of you who had, we covered it in financial management, or it should have been covered even if you didn't have me. And then also, again, you had it in cases and stuff, but remember it said take the R sub F, the risk-free rate. I'll just spell it out. Risk-free rate, which typically would be the rate on what security would we use for the risk-free rate of interest?
10-year government bond note.
Yeah, exactly. Yeah, the 10-year treasury. So like if you looked up the 10-year treasury today, well, let's go to, and they probably have it on here too, but let's just go to WSJ.com, the Wall Street Journal, and go to markets, and gotta wait a second here. Now, I didn't want that. I want to go to let's move this somewhere. Oh, there we go. Oh, okay. I'll just put it down there. Well, where the heck was, I wanted to go to, all right, let me go back. I want to hover over markets, and then eventually you should see market data. What the hell? Oh, there we go. Market data, and you can go, you could hit bonds and rates, but you can also just go to market data home. On the home page for market data there, we look, yeah, and it's taking a while to load here. Maybe because I got so many different things open. Let me close some of them. Well, okay. Still close that one. Well, normally it doesn't take us long to come up, but anyhow, under market data, it'll give you like let's just go straight to bond. Maybe that'll. Normally, it just pops up on this home page for market data. It's not, but anyhow, you can find the 10-year yield on there. All right, so forget that. It's right now. Okay, and again, let's move this. Let's actually move it down here. All right. So going back to this one, it equals the risk-free rate on 10-year treasuries plus a risk premium. Now, what we're told for the risk premium, and I'll have to go to insert here and try to find the beta symbol. Tell me if you guys see it. Anybody see beta? I don't see it right there yet. Is that beta? I'm not sure it is. It's kind of a crooked B looking thing. Usually I just type in B, but I don't know. Where the hell is beta? All right, forget it. I'll just use B for beta. I'll just spell out beta. Okay, beta times then the risk premium for the market in general, which the risk premium for the market in general is the required rate of return of the market over and above the 10-year treasury interest. So now Morningstar, he does talk about it briefly in the book, in your book for this class. He does talk about finding K sub B using that capital asset pricing model. But then he says at Morningstar, they don't really use that. They more just look at stocks and try to determine, based on the riskiness of the company, what a reasonable K sub B should be. Okay, so I think in the book he said for low risk stocks they start at 9% and could go up as high as 13 or 14% as the required rate of return. For companies where the fair value uncertainty level is high or very high. Nowadays, I know they'll use a K sub B as low as 8%, a required rate of return as low as 8%, maybe even 7.5% for a very safe company. Because interest rates are so low, so if you just want to say, okay, address the risk of the company, if you want to calculate K sub B this way, you can, but be careful. If you end up with any number below 7% or 7.5%, go higher. Okay, use 7.5%. Yeah, is there maybe as low as interest rates are today? Just use 7% as the lowest possible K sub B for the very safest companies. Okay, and then adjust accordingly. All right, so if it's a company of medium risk, I would say by today's standards, probably an 8.5% rate of return would be average. So let me just put that down here. So K sub E, back to the home thing here, subscript, K sub E and then I'm going to say equals, let's go with 7% for a low risk company. And then let's say it would equal about 8.5% nowadays for an average risk company. And of course, whoops, how did I get that thing in there? And obviously for higher risk companies, it's going to be greater. Whoop. Oh, maybe I'll move this footnote down to the next page. Okay. And so for a higher risk company, oops, it's going to be, and I'll just use my greater than sign, greater than 8.5% higher risk. Say anywhere from 8.5, maybe instead I'm going to say it this way, 8.5 all the way as an average risk company, all the way up to say 15% for a higher risk company. And if a company is so risky that your required rate of return is greater than 15%, at that point it's probably more of a speculation than it is an investment, and you probably wouldn't be able to accurately value that company anyhow. Okay. Yeah. Let's go with that guy. Okay. I'm gonna save that. So, all right. Anyhow, so you can either determine your own case. Well, you'll have to determine your own case of B, the required rate of return of stockholders. Again, you can try it using this risk-free or using the capital asset pricing model. Take the rate on 10-year treasuries, take the company's beta, multiply it by a risk premium for the market, and then I'll put the average risk premium for the market historically has been about 5.5%. Okay. So, I didn't want to do it that way. There. Okay, so again, it's up to you guys how you determine it, but first look at the riskiness of the company. And again, I'm looking for that there's no right or wrong answers on this, but some answers and assumptions will be reasonable and other assumptions would be unreasonable. So that's kind of, what I'm looking for is reasonable assumptions. Am I looking for an accurate valuation? Well, who knows what's accurate? I can't tell you what an accurate value is for any given company. I can tell you, what an accurate range seems to be. But Morningstar, even if an analyst doesn't cover it, Jean Pierre, Morningstar will still have a fair value estimate based on a very quantitative model. If you go to the finance page at yahoo.com and look up the company there, they're going to have a target estimate, a one-year target estimate for where they think the stock will be trading in a year. So, so they're, but again, don't feel bad if you come out and say, well, gee, the current market price of the stock is $23 a share, but I came up with a value of $45 a share. If your assumptions are reasonable, then don't change it. Okay? Because again,
I asked a question.
what's that?
I wanted to ask a question.
Yes, Ellen.
What would be your opinion, supposing you end up getting all negative free cash flows for both companies?
Well, if the free cash flows are negative now, the assumption has to be at some point they're going to turn positive. Otherwise, all that company is going to do is destroy shareholder value until there's no value left. So it may have negative free cash flows for now, but if that's expected to continue, then that would not be a company to invest in, and that would not be a company I would use for this assignment. You have one that's kind of looking like that?
Yeah.
Okay. Do you mind if I ask who it is?
Yeah, we're trying to, take a look at it again. Maybe something might have gone wrong.
Yeah.
Yeah, and then after that, we decide either to change or probably look into the future more and then make.
Okay.
Yeah, Rob.
Yeah.
Rob, yes,
Sure.
we noticed that. So the cash flow are negative for the last 3 years, but on Morningstar, we were able to identify the growth, like the growth rate of the revenue. So when I use that growth rate for the forecast, so the free cash flow, when we complete that, the free
Right.
cash flow become positive. So it's
Good. Okay.
yeah, we use that information on Morningstar, and then we apply for the next 5 years, and the cash flow become
Awesome.
positive. So we
Yeah.
continue with the valuation of
Yeah.
that
So
company. Yeah.
so that is fine. Yeah, that is fine if the cash flows are negative, free cash flows are negative the first few years. But the assumption has to be at some point they're going to turn positive, or the company's not worth anything. If it's never going to have positive cash flows. Those of you in cases, and Jean-Pierre, I know you were in cases. Remember when we did? We didn't do it in this class, in the last class. Yeah, you guys didn't do JetBlue, did we? Okay. There was in the previous edition of our cases book, we did a case on JetBlue where like the next 7 years the cash flows were going to be negative. They were becoming smaller and smaller negatives until they finally started becoming positive and growing over time. So yeah, that's fine. But if it's never going to have positive free cash flows, then it's worth zero. Yeah. Okay, any other questions? That was a good question, Helen. Any others? No. Okay. All right. Well then, let's move into the worksheet. Okay, so any questions on the handout itself? So it's all right there, and then again, I will replace the DCF handout. Since I added some things on it, I'll put the updated sheet on there. Okay. All right. Well, then let's go to the worksheet. That's the review. That's that. Here's the worksheet. And remember, I said you only have to do parts A and C. And I use 2014 up there. So this should say 2015. not 2011. And oh yeah, one thing. You know what? Let me change this to 2019 and change this to 2020. I think I told you guys that because, you know, I had used, those of you in the cases course, I had used, you know, the worksheet where we were using past years, but we were assuming we're sitting at like 2015, trying to value a company when we got cash flows for 16, 17, 18, et cetera. And unfortunately, what I found is with a lot of the day students, they went back 3 or 4 years with past cash flows to value a company today. The value of a company today entirely depends on future cash flows, not past cash flows. The only way past cash flows affect the value of a company is if the cash balance is, you know, if you have an excessive cash balance more than you need to operate the company, you can assume that that cash could have been returned to investors. So you would add that onto the present value of any of your future free cash. Again, the value of a company is the present value of your future free cash flows plus any excess cash the company has already accumulated. Okay, so I'm going to save this. I'll replace valuation worksheet 2 then. So, all right, assume the following data is for Walmart for 2019, and so I give you a bunch of different information. Determine the free cash flows to equity for 2020. Well, the first thing you're going to have to find there to answer question A is what is my net income? And then once you find the net income, you'll subtract out capital expenditures and the increase in net working capital. So, all right, and then C says assume those free cash flows to equity will grow at an annual rate of 9% for the next 5 years and at a constant rate of 3% thereafter. And that assume the cost of equity is 10%. Find the intrinsic value of the equity, okay, of the firm. I didn't have you find it per share, but obviously per share, you just divide the value of all the equity by the number of shares outstanding to get a value per share. Okay, so now let's go to the solution. So here is, whoops, I didn't click on the right one here. No, that's the worksheet. That's not, oh, I know. The solutions are up here. Well, let me go with this one. This is page 1 of the solutions, and this is all on Brightspace. Okay. So you're starting with EBIT, earnings before interest and taxes. I mean, the only reason you would need sales is to eventually figure out your earnings before interest and taxes and so forth. So since you've already got it, you can ignore sales. Take that earnings before interest and taxes. And since we are doing free cash flows to equity, where we're going to start with net income and then make those adjustments, we do subtract out interest expense. Those of you who've had cases, remember that if it's free cash flows to the firm, you do not subtract out interest because you're going to find NOPAT, what we call NOPAT, net operating profit after tax, and interest isn't subtracted out, but then you use the WACC to discount the cash flows back to present value, the enterprise value, et cetera, et cetera. Okay. So that's that. Subtract out the interest, which was given as 2.2 million. That gives us earnings before taxes, or 2.2, these are billions. Earnings before taxes, 23.3 billion. So given that the tax rate was given as 32%, multiply that by 32% to get your taxes of 7.456 billion. Subtract that from earnings before taxes, and that's your earnings after taxes or net income, $15.844 billion. Now, the adjustments you make, add back in the depreciation expense you were given above of 7.6 billion, because it was a non-cash expense that still got subtracted out before you ever got to your EBIT. Then subtract out capital expenditures, because that never went on the income statement, but that you would have spent 12.7 billion in cash on those capital expenditures. Okay, and then also subtract out the cash outflow from the increase in net working capital of 1.6 billion, and that gives you free cash flows to equity in 2020 then. So I got to change these numbers too, don't I? Oh, it's on the, this one I can't, that one I'll have to download and then enable it. I think I already tried that. Evaluation worksheet, OneDrive, save. Okay. Now, if I open it like that, it still does the same thing. I don't know. Anyhow, worksheet solutions. I'll put the new years on the worksheets. Remember, this should be 2019 here, and then it should be asking for the free cash flow for 2020. So that's what you should get on the free cash flow to equity, 9.144 billion. Any questions on how we got that number? Okay. Well, next, let's go to the valuation page 2, solution page 2. Okay, so, oh, I'm sorry. That would have been the free cash flows for 2019. Okay, let me go back here. Okay, so this is for 2019 right here. Okay, so let me make that 2018. There. Okay. Okay, so that's 2019. And then, okay, getting back to our solutions. Whoop. Oh, that's right, it's up here. Okay, so year one, what you would have done to get this 9.967 billion is take the free cash flows for the past year, 2019, of 9.144 billion, and then we were told that they were going to grow at an annual rate of 9% for the next 5 years. So if you take 9, and again, you might want to just grab your calculator now just to check it out. Take 9.144 billion, multiply that by 1.09. That's 1 plus the 9% rate of growth to get then the free cash flows. Whoops. for year one of 9.967. And then take that number times 1.09. You get the free cash flows for year two at 10.864. Take that times 1.09 and then again and then again. So in year five, you should get free cash flows to equity of 14.069 billion. Now, at the end of that period, you're going to have a constant rate of growth. So we can find the terminal value at the end of year five here by taking the free cash flows for year six, which will equal the free cash flows from year five times 1.03, because remember, after year five, we're going to have a constant growth rate in cash flows of 3%. And then divide that by K minus G, the required rate of return of 10%, minus the growth rate in cash flows of 3%. So divided by 0.07 gives you a terminal value 5 years from now of 207.018 billion. Now notice what I did here is I add that number to the free cash flows to equity for year five. So I have total free cash flows for year five of 221.087 billion. Both these free cash flows as well as the terminal value both have to be discounted back to present value for 5 years. So that's why we add them together to discount the total back to present value for 5 years. When you set that all up on your financial calculator, you should find a present value of $173.031 billion. That's the intrinsic value of the equity. So of course, to get an intrinsic value per share, you would have just divided that by the number of shares. Okay. Questions? You know what? I should put a financial calculator handout on there too, for those that maybe haven't had me for other classes. So you can see how to find the present value of different cash flows over time using the cash flow work. I don't think I have that on there, do I? Let me just go back to here. Rubrics, articles, worksheet, review for final. I put that market history on there from last time. Yeah. No, I didn't. I don't have it on there. So I will put the financial calculator handout on there, because not all of you have had me before, so you may not have had access to it. Questions going back to this final solution here in part C. No questions? Okay, well, we'll call that good then. All right. So let's go back to the review sheet. Discounted cash flows using free cash flows to equity. And I'll just put dash C handout. See handouts. I got the handout plus I got handout, and I'll put the financial calculator handout on there too. And work. Any questions on that? All right. Well, the rest of it, like I say, is mainly loose ends. In Chapter 11, they did an analysis of AMD and Biomet. And AMD is Advanced Micro Devices, which makes computer chips, much like Intel. And Biomet makes medical things, primarily artificial joints. In fact, now it's called Zimmer Biomet Holdings. I own stock in it because they were taken private for a while, and then they went public again, and then merged with a company called Zimmer, which also makes medical or joints, artificial joints for people, hips, knees, shoulders, all that kind of stuff. So did you guys read chapter 11 here? I'm gonna put you on full screen here. Anybody read chapter 11 yet? Yeah. You know, it'd be a good idea to read through it and then just you know, see what you think. But basically what it amounted to was, it looked like when they went through analyzing each company, looked like AMD was vastly overvalued. By the way, I have always thought AMD is a horrible stock to own, but it has had a really good year the last year or year and a half. And that's because they came out with a new chip that is actually better and faster than Intel's. Now, they do that every so often. Every, I don't know, 10 years or 15 years, they'll come out with a better chip than Intel. But usually it's only a year or two before Intel comes out with a better chip than AMD, and AMD goes right back down again in terms of the stock price. So I'm not sure where their stock price is right now, but that is one I have considered shorting in the past. And the Biomet actually seemed in their analysis to be about fairly valued. Okay. What else do we got to cover? Wall Street Journal article on growth stocks and how to determine growth in earnings per share needed to obtain a reasonable return over 10 years. And I say I'll have one multiple choice question on it. Okay, so I have the article up. Well, I guess I closed it, so let me open it again here. I had 4 articles I had put on here. You know, it wouldn't hurt you guys to look at the other 3. Here's one on return on invested capital. And then here's the one on growth stocks in general. So click on that. And the guy did some really interesting analysis to back into how much earnings would have to grow on an annualized basis the next 10 years to make Chipotle stock worth what it was trading at back at the time of this article. Okay, so if we look at the article, okay, yeah, and there's some good early stuff on it too. And notice he talks about return on invested capital. Yeah, he talks a bit about a few different companies, Priceline and Apple and so forth. Okay, Google, McDonald's. Okay, so here's what he does. He says, first of all, figure out what the share price, if you've got a growth stock, you got a growth stock. Figure out what the price would have to be in 10 years to get a 10% annual rate of return, if assuming you would consider 10% a good and reasonable rate of return on that investment, right? So at that time, Chipotle was trading at $398. If you have a financial calculator handy, in fact, take it out now. I'll give everybody a minute to grab their financial calculators, because it will be helpful if you go through this on the calculator with me. Okay. So I'll give everybody a minute to go grab their financial calculators. If you don't have it, you know, I guess just try to follow along, and then and it's only one multiple choice question, but I think it's a really good way of doing an analysis where you back into a number like what would the annual growth rate over the next 10 years have to be in earnings per share for this stock to really be worth what it's trading at today. Be maybe a good way to back into what kind of growth rate would Tesla have to be worth what it's worth today. Okay, if we got everybody back, I'll look here. Well, everybody who has a picture is sitting in front of their computer, so I'll assume everybody's back. Okay. So on your calculator, at that time, Chipotle was trading at $398. So first thing to do, remember, always clear out your time value register. Hit second, clear time value of money, which is the second function of the FV button. Second, clear work, which is just the second function of the clear button, and then just hit clear again. Okay, now hit 398 and then hit the plus minus to make it a negative and hit PV for present value, because that's the price of the stock today. Now, in order for that stock, and then let's see what kind of return we'd have to get for the stock to grow to 1,000 or to grow at a 10% annual rate. So hit 10 IY, okay, and then this is after 10 years, so hit 10 N. Finally, hit compute future value, FV, future value. And you get the number he's got there to the nearest dollar. You do get $1,032. Okay. So in order for you to earn, and again, if it's a rapidly growing company, you're not expecting any dividends over the next 10 years, right? Right? Growers don't pay, rapid growers don't pay dividends. So if it's a rapidly growing company, the odds of it paying dividends, or at least any significant amount of dividends in the next 10 years is extremely low. Okay. And if they do pay any dividends, it'd probably be very minimal and come just at the tail end of that period anyway. So we're going to assume to get a 10% rate of return on this stock after 10 years, the price would have to grow to $1,032. Next, assume today's high PE ratio, which at that time was about 46 times for Chipotle, will have fallen to 15 a decade from now, which is roughly the historical average for stocks. Well, nowadays, because interest rates are so low, I'd probably figure 20. But back then, before interest rates were as rock bottom as they are now, yeah, you know, to say, okay, so if a year from or 10 years from now, it's trading at the historical average PE for the market in general of 15 times, what would earnings be? So divide that $1,032 by 15, and that tells you earnings would have to be $68.82. Okay. He just rounded it to 69. Okay. So earnings, if you divide that $1,032 by the PE of 15, that says, okay, if it's trading at a PE of 15 times 10 years from now, assuming that its growth will be up 10 years from now, and then it'll be at a constant rate of growth like an average stock, and would trade at the same multiple as an average stock of 15 times, then again, you'd say, well, then that means earnings per share would have to be about $69 a share 10 years from now. So make that your, if you clear out your time value register, make 69 your future value at 10 and, because this is what earnings have to grow to after 10 years. Now he said at the time, analysts were expecting $8.70 a share that year for earnings for Chipotle. So put in 8.70 and don't forget to hit your plus minus button to make that a negative 870. Hit the PV button, present value. That's the earnings this year. 69 is your future value. That's the earnings you'd have to have 10 years from now. And 10 and finally hit compute IY, and I get, this says 26% a year. I got 23%. You guys get 23?
Yeah, that's what I got.
You got 23 also?
Yeah.
8.70 negative present value, 69 positive future value. Oh, you know what? That's because he's using this as the year one earnings. He's using 870 as the year one earnings. So instead of 10 years, we should have used 9 from year 1 to year 10, through year 10. So 870 is the earnings expected for year 1 is what he's saying. Okay, so make 69 the future value, and then present value, whoops, okay. 8.70 negative is my present value. 69 is my future value, but this time put 9 in. Because again, 870 was what he assumed would be the earnings in next year, year 1, and 69 in year 10, which is 9 years later. And then compute IY. Yeah, I get now 25.87%, which he just rounded 26. So you have to ask yourself, well, is it reasonable that that company can grow earnings per share at that kind of a rate? Now, you could use earnings or free cash flows for Tesla and do the same kind of work. Now, of course, one of the things about this is assuming that the PE will be 15 times 10 years from now. Well, for Tesla, number one, interest rates are low. Number two, they may continue to grow faster than average, even 10 years from now. So maybe, you use 20 as a PE for Tesla 10 years from now. And then figure out, okay, well, using, taking the current market price and then look at the estimated earnings per share. Should we just do it for Tesla? Let's just do it. Okay. So let's go to Tesla. So I'm going to go to finance.yahoo.com. Okay. Move us over here. There we go. Okay, I'm going to put in Tesla. TSLA. Okay, currently trading at 13 or closed today at 1365.88. Okay, market started out up a little bit today, but I think did it end the day down? Might have. This is the futures, not the actual market. It ended the day down a smidge. I'm not sure where it ended. Anyhow, oh, look at the 1-year target estimate for Tesla. $735.14. That's what analysts think it'll trade at a year from now. So if you're buying at 1365 and analysts are right, you're gonna take a heavy hit. But of course, what happens is when a price keeps going up, analysts go, "Oh, we must have been wrong." They'll start raising this target estimate. And they may not have been wrong, because maybe that is where it'll be in a year, but they'll definitely, this will be going up over time. You watch. Okay, and it doesn't pay any dividends because it's growing, and it likely would not pay any dividends in the next 10 years. So for us to get a 10% annual rate of return, okay, clear out your time value register, put in 1365.88 as a negative present value. Now, if you want to get a 10% rate of return on Tesla over the next 10 years, hit 10 IY, the annual rate of return you want, NN for 10 years, and then hit compute future value. Okay, Tesla in 10 years, for you to get a 10% annual rate of return, would have to be trading, I'll just round to the nearest dollar, $3,543. Okay, now, it's not likely to be trading at a multiple of only 15 times earnings 10 years from now. More reasonable, maybe 20, maybe 25. I don't know. Let's use 20. So now we'll divide that by 20, assuming the PE is going to be 20 times. If we divide that price 10 years from now, we would have to have by 20 to get the earnings. That means earnings would have to be, and again, I'll just round to the nearest dollar, $177 per share, 10 years from now, okay? Now, what are earnings projected to be next year? Well, let's go to analysis here. And next year, earnings estimate, the average estimate is earnings will be $11.29 next year. Okay, so put 11.29, then hit the plus minus button to make it a negative present value. Okay, put in 177 as a positive future value. Now remember, since that's next year's earnings, and we're looking at as our present value, and our future value is the earnings in 10 years. So from the end of year 1 to the end of year 10 is 9 years. So hit 9, 10. Finally hit compute IY, and that's the annual growth rate we would have to have in earnings to make it worth what it is today based on those assumptions, which is about 35.77, call it 36%. Do you believe Tesla's earnings will grow at an annual rate of 36% annually over the next 10 years? Well, let's scroll down. Over the next 5 years, analysts are projecting earnings are going to grow at a 282.38% annual rate. Now, that was based on earnings, though, over the past year, which again, well, right now, for the current year, they're estimating 405. Okay, so that 282% growth rate for the next 5 years is actually probably based on trailing 12 months earnings. What was trailing 12 months earnings? If we look, summary. Oh, no, it couldn't have been, because the trailing 12 months earnings are still negative. Still negative. So they must have said, okay, use 405 for next year, and then come up with that 200 and some percent growth rate. That seems awfully optimistic to me to assume a 200 and some percent growth rate, but over the next 5 years in earnings per share. And again, that's an annual growth rate, 282.38 per year. Now, again, are we going off for the 405 for the current year and then the next 4 years to come up with that annual growth rate. You know, even from 405 to the following year. That doesn't make sense to me, because look at this. Divide the, oops, that's revenues. Divide the average estimate 1129 by 4.05. We're expecting a growth rate of, well, 278%, call it 279% in earnings the first year. Would we expect it to continue to be able to grow at that same rate for the next 5 years? I just think this is horribly optimistic, but a 36% annual growth rate the next 10 years does seem a little more realistic to me. But again, I tend to prefer to value companies based on free cash flows rather than earnings. That's where Tesla loses out. Hang on, I got to go let my dog out. I'll be right back down. Hang on, buddy. Come on, Harvey. Okay. Yeah, I think I would prefer to look at this using free cash flows and then decide whether I think it's reasonable value or not. But based on those estimates using earnings, it doesn't really seem out of the realm of possibility. It doesn't seem unreasonable. But again, that's using earnings. Okay, well, finally, let's get back to our review sheet. Okay, the 10-minute test to determine if a company needs or is worth spending more time on. Because basically what, you know, like the author says, there's a lot of work that goes into I'm just looking below that. Anyhow, a lot of work that goes into a full analysis of a company, and nobody has the time to do that for every company. So, find my notes here. Give me just a second on the 10-minute test. There's chapter. Oh, the 10-minute. First of all, he says, look at, include all what they call bulletin board stocks. Okay. And again, this is all in the chapter, but he says exclude bulletin board stocks. Maybe I'll put some footnotes here. What am I trying to? Oh yeah, change the list. Exclude bulletin board stocks. Sometimes they're also called pink sheet stocks. Those are stocks that are not listed on any exchanges, not on NASDAQ, not on the New York Stock Exchange, not anywhere. How do they publicly trade? Only through the dealers that make a market for those stocks. So there's a handful of dealers that'll make a market for stocks of different companies, including thinly traded companies, and those dealers will act as the buyer for sellers and as the seller for buyers, and then they take the difference between the bid-ask spread to make money. Well, the thing about that is, first of all, those bulletin board stocks, the bid-ask spreads are generally high to begin with. Number two, that's usually penny stocks that are trading at like maybe $1 a share, 50 cents a share, $2 a share, and those are extremely risky, and usually those companies fold up. Okay. So exclude all bulletin board stock. He says also exclude bulletin board stocks and foreign stocks that do not release quarterly financials. Some foreign companies do release quarterly financials, not all do, even if they're traded on the US market. Aegon, if you check Aegon, they don't have quarterly financials. Also he says, and exclude all IPOs and initial public offerings. Because again, usually the average investor like you or I do not get in at the offering price. And so the first day it goes public, usually if there's a lot of excitement about the stock, the first day it goes public, it'll start trading way higher than the offering price. And more times than not, within a couple months, it's back down to the offering price. I've seen that happen time and again. Obviously, sometimes it doesn't work out that way, but the vast majority of times it does. So if you're going to play the odds say don't buy IPOs. Okay. He also says exclude companies that have never made a profit. So I'll just put and there. Companies that have never made a profit. Now, I know you're thinking, well, okay, if we look at Tesla, yeah, they've had some quarterly profits, but trailing 12 months, they've never had a 12-month period of profits. Yeah. And you might say, well, that would mean I can't buy Tesla. Well, I guess if it's making quarterly profits, maybe we could bend the rule. He just says has never made a profit. It is making quarterly profits and is expected to make annual profits going forward. So that I probably wouldn't throw Tesla into that category. Okay. Now, what should you look for? So right there, that's going to eliminate a lot of them. Look for consistent operating cash flows. I'll just put it OCF, operating cash flows. Look for returns on equity that are greater than or at least equal to 10%.
10%.
What is else? Look for consistent earnings growth. And, look at the balance sheet. We want companies with low debt. How low? Well, he says, you know, like debt to equity, like long-term debt to equity. So you have long-term debt to equity, which is just your long-term debt divided by stockholders' equity, less than 1, less than or equal to, I guess we could say, less than or equal to 1. Okay. And what else? You'd prefer positive free cash flow. You don't like companies that have a history of one-time charges. We've mentioned that before. You don't want companies that are constantly increasing the number of shares outstanding. Okay. A decrease in shares outstanding is good if they're buying back shares at a reasonable price. And then he says, okay, now if a company passes all these tests, wasn't on the exclusion list and has some of the things you're looking for, then you can go ahead and analyze it. He says, look over 10 years of financial statements for the balance sheet, statement of cash flows, income statement. Says, read the most recent 10K. Says, look at the 2 most recent proxies looking for reasonable compensation and option policies. He says, look at the letter to stockholders in the last 3 annual reports to see if, do they gloss over problems or are they realistic about problems? Yeah, he says, look at the most recent 10 Qs for any news or changes. And of course, 10 Qs are the quarterly financials. And he says, be sure to do a valuation of the company and at least do a rough DCF cash flow, discounted cash flow analysis to value. That's all chapter 12. Let's see. 13. Yeah, that's about it, I guess. Let's see. There will be a few questions on Warren Buffett in the 2017 Berkshire Annual Report. Each of those questions will have the answer given since we didn't cover that. I'm going to leave that on there for this test because I think there's some really good stuff in his 2017 annual report. So I'm going to leave it on the test, but again, we didn't get time to cover it. I'll just give you the answers. Okay. Red flags and pitfalls, I'm not sure. We already talked about those back in chapter 8, so I don't know why I have that on there again. Do I have it up here somewhere? No, the following. Yeah, okay. Red flags, pitfalls. We already covered that. I guess that's just redundant. Risk factors in chapter 10. Again, we did go through those: size of the company, financial leverage, cyclicality, economic moat, management, stewardship, and complexity, and be capable of finding the intrinsic value per share using discounted cash flow analysis, and again, only with free cash flows to equity. And like I say, I'll make sure the test stays all multiple choice questions. And I'll get some updated handouts to you guys on Brightspace sometime tomorrow afternoon. You can take it anytime Friday or Saturday. Papers due by noon Monday. Anything else?
Nope.
Okay. I hope I see a whole bunch of you guys, maybe even all of you at MoCo on a week from tonight at 5:30. So have a great week. Oh, again, I'll do the 3-hour time limit. I think I mentioned that. Okay. Have a great week, and hopefully I'll get to see you in MoCo next week.
All right.
Bye, everybody.
Bye.
Yeah. See ya. Well, now what do I do? Okay. Ah, here's my thing.